Good morning. It is Thursday, September 4th. I'm Zach Howard, and we are starting an NFL season here this evening. Pretty excited about that. What's not so exciting is probably what I got to talk about today in my slides. Boring bond markets and boring Asian equity markets that no one really focuses on. But that is what macro is, and that's what really can give us more signal than just looking at stock prices and US equities from time to time. What's the story around the world? Most gold equities are trading at all-time highs thanks to the backdrop of debasement of fiat currencies. That's really the reality. However, some countries are not really in the frenzy bubble as such rate of change more than others, particularly in countries that participants ex their individual countries can't really or want to get involved in. China continues to be an outlander and a contrarian play compared to Europe, compared to Canada, the UK, and particularly the US. China, though, has a money printer that's been burned long since the US stopped theirs and will continue to do so. The thing with China is they continue to play by different rules than in the West. We had a big military parade in China this week with Putin, Kim, and Xi. Really was a people joked the gold summit. We've seen gold price run up on the news. But gold buying by China and hard assets continues to be a theme in lieu of tech stocks and U.S. equities, as we see in the U.S. The devaluation metrics in China compared to other markets are normally higher than they are currently. So attractive contrarian play for sure. When we're looking at the U.S. concentration, really is in those tech stocks, those 7 mega cap stocks, along with Nvidia, Microsoft, Google, etc. 36% of that 53 trillion dollar fiat S&P value. China was back in the early 2000s, before it kind of cratered down, had a higher concentration as well in their top 10 companies, but not so much anymore. More broad and more diversified. Like I said, they don't have to play by the same rules. There's 70, 80 EV companies in China. Everybody knows they rip off Western tech and IP to stimulate their technology sector. Copyright doesn't really exist. Even Chapman out there, the king of SPACs, the big all-in guy on the podcast, and the former Facebook executive turned venture capitalist, he's out saying, you know what, China is really interesting because they are actually embracing what is needed to evolve as a society to continue to advance, which is energy. We need abundant amounts of energy. And China has the Three Gorges Dam hydro project. They have all these coal plants. They're kind of bringing on nuclear as fast as they can. There's a new pipeline from Russia, from Mongolia being built. China recognizes for its citizens to advance, embrace all the things that are energy in the earth and build it. Build it as fast as possible, which is not what we've had in the West. We've had pipeline protests, red tape for this environmental, yada, 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 and it slows down growth. So China is accelerating. Let's move next door to Japan. And the other focus on my mind is bond markets. And the long duration side of the bond market continues to rise globally. The poster child of this is Japan, which has been playing with this Frankenstein monetary policy the longest, negative interest rate policy for years. The difference between a short duration bond, like a 2-year T-bill in the US or something like that, is where companies and countries park cash. They don't park it at their Wells Fargo checking account if you're an operating oil company, some international jurisdiction. You're buying it in a government short duration safety trade, so supposedly. However, on the long duration side, 10, 20, 30-year bonds, they are an asset on the balance sheet. You're not putting cash there. So all of a sudden now, countries are competing against hard assets with this fiat debasement being more visible for what's actually happening, the devaluation of currencies. So we've seen a massive increase in the rate of change of Japan 30-year auctions here since in the last year, roughly 200 basis points back last September. Now, one here this morning, 3.2%. It doesn't sound like a lot, but 1.2% on a number this low, that's a massive rate of change increase in a short amount of time. This current auction here went today 1.76 trillion yen, roughly 12 billion US dollars. The bid to cover ratio on this auction 3.31, not great, not bad. A little bit poorer than previous auctions. As has been the case for the last three auctions, the Bank of Japan has been, I guess, the missing link in what the auction was and what the actual market participants wanted to bid for this Japanese paper. Bank of Japan bought 169 billion yen of the auction. Pension funds bought about 300 billion. But the takeaway here is the rise in interest yields on this long duration paper. This is setting up for massive dislocation of capital globally in all these long duration bonds. The long duration bond blowing out like this in all these countries in the G7, G20 is a result of unsustainable fiscal spending by governments. They're not accountable to math. Back in 2021, now those chickens are coming home to roost. You look at every one of these countries, you've seen the same similar pattern. The black line is the central bank policy rate that they can control. And all those policy rates, the Fed funds, the Bank of Canada, etc., they continue to come down. You're looking at contrasting that with the red line, which is what the market is saying. Those yields go higher, a big divergence, especially as growth will actually continue to be stimulated from a nominal perspective in these economies from a rate of change. So there's a big divergence happening. Central banks are cutting rates, but the long duration yields, which they can't really control unless they buy those bonds in the auction markets, like I just showed you with Japan, will continue to rise. And the holders of those long duration bonds will continue to be under pressure for what the valuation of what they're holding is in that paper. Looking here at the US, the 10-year triple B, not junk, not high grade, investment grade, in between, the spread on its yields continue to fall, which to me it says there's no stress currently in that market. If we are going to see a spin-off from government fixed long-term duration yields rise into other markets, we're going to start to see it blow out in the high yield space. This is a chart of the high yield credit space. It has not moved. It's still down at one of these super historical low levels, only seen before the GFC, seen back during COVID. It can't really go any lower, but the question is, how quickly can it rise, and when does it rise? Could that be a potential sign for stresses in other markets? That's one of the things I'm paying attention to. I don't see that on the horizon currently, but this puts in perspective the risk return for buying high yield and owning for a long duration asset doesn't really align currently. This week in U.S. administration, Trump, best policy saying, you know what, the U.S. is in a housing crisis. Canada's been saying this for years. It's not a result of supply-demand dynamics. It's really a result of policy making, trying to influence what the market is with all the central bank cheap money for the last 5-10 years and what that has resulted in. There's a massive amount of equity wealth effects sitting inside of boomers' homes in the US. The difference here between the debt and the owner's equity has never been this wide. The Trump administration saying, you know what, we can juice the economy even more if we can spark some kind of initiative, a financing program to unlock some of this. Maybe that's private equity. Maybe that's through Fannie Freddie's. Something is coming in announcement in the next little while that's going to spur more animal spirits in equities and in the overall economy, I believe. Couple of nice charts here on the right from Apollo. Obviously, the high cost of housing is preventing household formation. In my country here in Canada, that's a common denominator, seems similar to the US and other G7 nations. It's just the cost and the limitations to getting it to own a home if you don't have equity or an asset starting out. It's simply impossible. You can't work your way into an asset class that's rising this fast, this quick over the last few years. Wages haven't kept up. The monthly supply of new homes in the US, though, despite what people say, it continues to be steady. New home versus existing sales in the US, new homes are not selling as quickly as they potentially could be if the Fed does unlock some of this. Not the Fed, but the Trump administration unlocks some of the home equity values there, and there's more people wanting to buy secondary homes, vacation homes, rental properties. Back to close out here on the macro front. In my notebook, the equity market in the US still says higher lows, higher highs. along the S&P and the Nasdaq. I see that Google's a strong mover here the last couple of days on its antitrust announcement, and then the global and the U.S. PMI data, which I talked about, anything above 50 is expansion, below 50 contraction. Some nice data here earlier this week. We're seeing some more here now in a few minutes come out of the U.S. for Thursday, September 4th. And this is the cool chart I came across. A divergence between the University of Michigan Consumer Sentiment Index, what consumers are saying when they're filling out that survey, and what Goldman Sachs tracks from its social media economics sentiment index. Kind of got up to extremes here, but in this level here, it's going in the opposite direction in 2025. Who's right? People on social media and everybody's positive about stuff, or is it the consumer sentiment surveys? Something to keep an eye on. In my book, Bitcoin still bearish trend, 107 and 111 ish. Gold all-time highs. Silver, $41 an ounce, busting higher. Risk on until it's not. Have a good one. We will see you again soon.